let's talk about the textbook that you co-authored with Professor Chesley from Stanford University, Alphanomics, right?
Sure. So Alphanomics is a textbook based on a broader literature, including my own research, that can be viewed as an attempt to reconcile the practice of active investing, which is so commonly pursued among Wall Street professionals, with the theory of efficient markets, which are so commonly taught in MBA classrooms around the world. So Alphanomics really reflects two separate terms. The alpha portion of Alphanomics refers to the abnormal profits or excess returns above risk compensation that engenders or helps motivate arbitrage as an industry. The economics could be thought of as the costs and benefits underlying active investing that make it sustainable as a business enterprise. And so in many ways, Alphanomics could be viewed as the recognition of the idea that in a world with costs and risks underlying arbitrage, the prices cannot reflect all fundamental information. Instead, prices respond to fundamental information, but also reflect things like fashions and fads, as well as innuendo disguised as information. As a result, oftentimes prices deviate from fundamental value. And Alphanomics helps identify or calls for people to identify sources of mispricing, as well as the need to protect oneself from risks and costs underlying arbitrage. And so what we try to teach in Alphanomics is a way for thinking about the world of active investing, and that the practice of active investing, what people should be aware of in terms of thinking about fundamental value, as well as how to mitigate risks associated with the practice.
Well, that sounds quite complicated, like a finance textbook rather than an accounting one. So what is the general implication for finance and accounting students then?
Sure, it's a great question. The implication is simply that in a world in which prices can decouple from fundamental value, we need ways or techniques for identifying cases where prices deviate from fundamental value. And so part of what we can do as researchers in finance and accounting is to identify low-cost techniques for understanding the nature of mispricing, to realize when value is quite different from price, for figuring out cases where prices are artificially too high or too low because of discretion in the financial reporting process that allows managers to misrepresent truth about companies. It's also the case that through careful analysis, things like fundamental analysis or valuation, we can find ways to identify and better estimate fundamental values of companies, and ultimately help improve the apparatus of arbitrage through more sophisticated techniques and application.
So that said, I mean, as an accounting professor from MIT, from United States, what do you observe from the U.S. market or the global market? What is the trendy part of the accounting profession right now?
That's a great question. There's a lot of different trends that I think that I could point to that really interest me and excite me. The first is, I think what we're witnessing is a dramatic change in the economic landscape of companies, particularly within the U.S. So in the U.S., for many decades, we're primarily focused on manufacturing goods. And so the traditional companies, think companies like GM that produced hard manufactured goods, are no longer dominating the landscape of the U.S. markets. And instead, we're seeing a shift towards companies that provide goods and services. The stocks that people are primarily focused on these days, things like Google and Facebook and Amazon. And this has a lot of implications for not only accounting researchers, but for the way in which accounting is practiced. Many of the rules were written for companies that followed a different economic process than the way in which companies are operating now. And we need to update the way in which accounting is practiced in order to accommodate those trends. And so oftentimes people talk about accounting in terms of traditional notions, things like that asset value should decline with use. But instead, we're seeing a number of companies move in the opposite direction, where greater use of assets actually leads to greater value. So for people who rely on things like networks for value, things like Facebook or for Uber, oftentimes the accounting creates a mismatch between the value and what's recognized on the financial statements. And so this has wide-ranging implications for the way we think about valuation analysis because it changes the mapping between financial statement and information and values of companies. It's also the case that there are many processes and institutional, institutional mechanisms that amplify the problems associated with outdating accounting methods. And so I'll give you a simple example. Many financial institutions across the U.S. identify what are called value companies, companies that look cheap relative to fundamental value. And the way that they do that is they will typically sort stocks or identify stocks that where their book values appear relatively high relative to market prices, the so-called book-to-market ratio. The problem is, in the modern U.S. economy, many companies have artificially high or low book values that don't represent the residual value available to shareholders if the company were closed down today.
So by artificially high or low, what do you mean specifically by artificially high or low?
I mean, the traditional notion underlying accounting is that assets equals liabilities plus shareholders' equity. So when you take all the assets of the company and you pay off all of their debts, their liabilities, the remainder that's left over, shareholders' equity, is meant to represent the claims that stakeholders have on the company. And so it's meant to represent the residual value that would be left over. But for many companies, if you took all their assets and pay off their liabilities, they may have negative shareholder value. But that's not representative of the fact that there are many assets that are valuable to the company, things like brand value or intellectual property, that are simply not incorporated into assets, but are a big part of the value that would be available to the companies.
So does that mean that we will need probably a brand new set of accounting standards to make the accounting rules more appropriate for these companies?
Not necessarily. It depends on the intended user base. It's not that accounting rules should be necessarily written for the purpose of valuation. We need a system for tracking changes in the economic value created. And of course, there are costs associated with incorporating components of a company's worth that are not things like hard tangible assets. So a big problem that exists within financial reporting is the fact that there's managerial discretion. And so if you think about things like brand value, it's really something that's difficult to measure. And so you could pose yourself the question, undoubtedly, things like Coca-Cola's, their logo, or even sort of their themes, are really valuable to the corporation. But it'd be hard to place a value on what that represents. And allowing companies the opportunity to represent that on their balance sheets, I think could pose more problems than it helps.
So if we do not change accounting standards, then what is the best way of helping the investors understanding the value of these brand names and so on?
Yeah, I think what we need are innovative ways for thinking about the value of companies to reflect the changing nature and economics of corporations. So they're no longer manufacturing firms, but towards service goods. And I think that we need to start thinking about companies in terms of their sustainable competitive advantage. So we've seen many corporations over the past decade that simply had no earnings, companies like Amazon, but instead had tremendously high valuations. What we need to think about is our abilities to forecast their longer-term cash flows, which should ultimately determine their value. But until we develop more sophisticated techniques for better forecasting those cash flows, I think that it's more subject to ambiguity. And in cases of ambiguity, more subject to potential mispricing.
Okay, so talking about technologies, there are a lot of technologies, new technologies out there, which is changing the landscape of accounting as well. Not only the landscape of the companies, but also the accounting itself.
Sure.
So, for example, AI. I think, as far as I know, the big four companies are already using the robots to do bookkeepings already, and also blockchain technology and so on and so forth. So, what do you think that these new technologies will change the accounting practices?
So I think both artificial intelligence and blockchain are going to revolutionize the way in which accounting is practiced. So take, for example, blockchain that will provide an immutable ledger in terms of transactions for understanding the way in which people exchange value. Now, this is unprecedented in that it provides an irrefutable system, a way of verifying transactions. And I think that in many ways, people are concerned that blockchain will take over the role of accountants. What I would argue is that blockchain is very likely to be revolutionary, but change the nature in which accounting is practiced. So rather than accounting sitting down to do T accounts, to think about recording transactions by recording a general ledger, I think accountants will be very much engaged in the financial reporting process as a way to think about the output of blockchain, the general ledger, and to make sense of the transactions that are recorded. Because a big part of the financial reporting process is the discretion that's afforded for managers to represent changes in economic value. So there are many transactions that are part of a broader system within financial reporting that are meant to provide managers with discretion in terms of thinking about what has changed within the company. A simple example are things like accounting for allowance for doubtful accounts. For a company, when a company issues credit to an individual, the likelihood that that individual is unlikely to pay. While things like blockchain can account for the transactions or sort of the agreement to engage in exchange of service, we still need accountants for figuring out what should we record in terms of things like revenue, which is certainly a big portion of what companies or investors are looking for in determining firm value. So I think that the application of blockchain is very likely to change the nature of accounting by shifting focus of how technology should be aggregated and ultimately used to summarize fundamental information about a company. Similarly, artificial intelligence holds wild promise for a variety of fields, and certainly accounting is counted among them. Artificial intelligence is very likely to be useful in determining cases where companies are manipulating their profits. It's likely to better understand the value of companies through learning by understanding where hidden or latent information exists within financial statements. But again, this is not in a change or threat to the field of accounting, but rather a change in the nature and focus in terms of the way in which accounting is going to be practiced. So whereas traditionally accountants would simply only have the need to understand the way in which accounting should be operationalized, that is, thinking about how GAAP procedures should be applied, I think there's going to be a new avenue for understanding how to engage with computers. Those who are engaging in artificial intelligence, to train computers to look at the right components, to provide a platform for thinking about the way in which accounting is practiced and how it could be harnessed to be used for a particular application, like valuation, for detecting fraud, for understanding limitations of the financial reporting process, and hoping setting new standards that could ultimately serve the investing public or stakeholders more broadly.
So, are you aware of any current case in the US or anywhere else or that they are employing robots or AI to do fraud detection in financial statements already?
Absolutely. I think that we're seeing this not only in application in which companies, audit companies, as well as hedge funds are beginning to use artificial intelligence to determine the value of companies or to understand irregularities within financial reporting. We're also seeing a wave of academic research which provides a testament to the value of these technologies. And what these papers or research studies are doing is that they're allowing artificial intelligence to determine what is suspect within a set of financial reporting. That is, it allows us to better understand the mapping between observed financial reporting and outcomes, things like restatements or ultimate fraud. Because by better understanding that mapping, we have a good indication of sort of key variables that we should be paying attention to. Where are the places that managers are exercising discretion, and what we should be looking for as an active investor to figure out, what are the sort of the key triggers or signs that something is going wrong.
So after, even despite all these new technologies, accounting profession will still exist for a long time.
That's my forecast. Yes, that's right.
Okay, so talking about technologies again, I mean, recently, China is establishing a new board which is called Science and Technology Innovation Board, which is going to be in the Shanghai Stock Exchange. It's a new board of listing stocks which benchmarks itself with NASDAQ in the US. So I know you are a member of the listing council of NASDAQ. So as a member of the listing council of NASDAQ and also as a scholar, what is your view of this board or what is your suggestion to this board?
It's a great question. It's tricky to figure out what I would recommend. I think part of what I have come to view over the years is that a listing on a stock exchange is more than simply a venue for trading. Stock exchanges now offer a variety of goods and services to companies that move beyond simply a host for trading their stock. So companies will provide, or the stock exchanges will provide, governance. They'll also provide marketing support. And so there are many facets to an exchange that make listing on an exchange useful. It's also the case that, like many other sort of network effects, it matters whether there are other companies that are sort of listed on that same exchange. And so there are peer effects from being associated with a technology index. So companies like listing on NASDAQ, I believe in part because there are many other, it's known for its technology, and there are many other sort of star corporations that exist on that same exchange. And so I think attracting some of sort of the initial leaders in the field, I think is going to be important for attracting others. It's also thinking about the products and services that they offer beyond simply listing, things like risk management, marketing, I think, governance. Those are a big part of what I think makes a stock exchange useful.
So we know that there are a lot of Chinese high-tech companies that are currently listed in the U.S. Probably actually most of them should be in NASDAQ. So what do you think that the new board, the Science and Technology Innovation Board in Shanghai Stock Exchange, will be a competitor to the NASDAQ, or will they, be complements to each other?
Well, it's a great question. It's hard for me to forecast. I think that it depends on, my guess is it depends on where capital flows are. I think a big reason why Chinese companies end up listing on U.S. stock exchanges because they want access to the U.S. capital markets and U.S. investors. And so some of this matters from a regulatory perspective in the sense that if there are limits on U.S. capital flows moving overseas, or if there's some source of information asymmetry or risk that prevents investors from investing in Chinese markets, that could also pose a problem that limits the ability or desirability of companies to list on their home market. And so it's not only a matter of what the stock exchange can do, it's a matter of what the government policy and procedures are in place that encourage companies to list on domestic markets. So Alphanomics critically relies on concepts from both finance and accounting. So what Alphanomics does is it challenges students to think about the arbitrage process, to find ways to develop lower cost techniques of engaging in arbitrage to identify mispricing. And so for a young researcher or a student who wants to engage in Alphanomics, there are lots of ways that you can contribute to the arbitrage process. For example, something as simple as developing new techniques for valuing companies. It would be quite useful in identifying mispricing, because the more that we can better estimate fundamental value, the better opportunities we'll have to understand or recognize when prices deviate from fundamental value. Another is to figure out signals that exist that investors do not yet seem to incorporate into price. Oftentimes, they're low saliency signals that tell us about fundamental value, but it's simply that they are sort of flying under the radar of the average investor in terms of valuation. And so the more that we can sort of uncover the sort of latent signals that exist within the financial reporting process, the better that we can correct mispricing. And so oftentimes, the financial reporting process engenders a lot of discretion. And what we know through large sample evidence is that managers will often use discretion to their advantage. They'll use their opportunity to say or present things in a favorable light to prop up the stock price, or perhaps to achieve some compensation requirement. And so the better we understand the discretion in the financial reporting process, the better able we are to reverse engineer the truth. And so the more that we know how managers are going to try to use discretion to their advantage, the more that we can reverse engineer truth-revealing signals and use that to their advantage. And so part of the research that I presented to students today was on the discretion that companies use in the timing of their earnings announcements. And the intuition that I gave to students is that companies are afforded a lot of discretion in when they announce earnings. They're typically afforded between 30 and 60 days to announce their financial performance. But there's a lot of discretion within that time frame in terms of when they announce. So some of the research I proposed to them today was a good example of what I believe alphanomics can contribute. It illustrated that companies follow a very simple pattern. When they have good news, well, they rush out to share it. They want to be the bearer of good news. And so when you see companies announcing earnings early, it's typically a good signal not only about their profitability, but their valuations. At the same time, companies often want to use discretion to delay the release of negative news. And so they'll push back the timing of earnings announcements containing bad news. And so that's an example where we see that there's discretion in the financial reporting process. We know that there is an incentive for companies to try to manage their reputations, or for managers to want to present themselves in a good light. So if a manager wants to garner attention for good news, they're going to rush out and share it, such that no one else sort of preempts their good news. They want positive information associated with their name. But at the same time, if they have bad news, typically what you'd see is a company will push back their earnings announcement in hopes that the information sort of leaks out ahead of time, that we can blame it on other sort of trends or people within the industry that allows me to sort of move away from some of the blame. And so that's an example where once we understand the discretion in the financial reporting process, which is something that I think any sort of student of accounting or finance can, if they really stop to think about it, can figure out where are the sort of the latent signals? What are managers doing to make themselves look better? And once we understand that discretion, not only can we sort of reverse engineer the truth, we can use that as an opportunity to incorporate information into prices in a more efficient fashion, and ultimately take away some of the incentive for firms to engage in that bad behavior in the first place. Further, I think we're really in an exciting time for accountants in that certainly big data is playing a big role in the sense that we have more and more information about the way in which companies are operating. We have bigger and bigger data sets that tell us about the nature of financial reporting. And the more granular data that we have available to us, the better able we are to recognize discretion, to get better estimates of firm value, to understand the sources and nature of risks, all of which are useful for active investors who want to generate higher returns with lower risk. And so alphanomics is really a call not to accept that prices are efficient or that they necessarily reflect all fundamental information, but rather through insights and hard work that we can identify information that's not yet reflected in price, and in doing so, contribute to more efficient markets.